This is a passion project for me. For the last 20 years, I have been proselytizing around the world for the idea of liquid private equity. And in the last 4 or 5 years, I've been working with my co-founder, Jean-Louis Leloger, who some of you may know. He co-founded Strategic Value Partners, SVP Global, the $18 billion alts firm. And so it was fantastic for me as a sort of academic from Harvard to be able to work with somebody who's actually built huge private equity funds and really understands what investors need and how to deliver it. And the notion that I had that I first spoke about in a speech at HBS all those years ago was that, look, private equity is fantastic. The performance profile is amazing. You beat the market on average by 2 or 3% a year. Obviously, the top quartile funds do even better than that, but let's just focus on average private equity, right? Even at the average, you're beating the market significantly. When the market crashes, you'll probably lose some money, but not nearly as much as the market does. You have very, very muted drawdowns relative to the market. If it's a mild crash, you might not lose anything at all. And finally, if you have a portfolio with a lot of stocks and bonds, correlation with those asset classes is low enough that when you add PE as a third asset class, you lower portfolio volatility at the same time that you are raising expected returns. And institutional investors around the world have seen this opportunity, and they have moved. In fact, if you wanted to summarize the last quarter century of institutional investing in a nutshell, you might say they went from 60-40, stocks 60, bonds 40, to 50-30-20 with 20% in private equity. Obviously, that's oversimplified. There's other alts and so forth, but it just gives you an idea of how crucial private equity has become to institutional investors. And so that is all to the good. But there have been 2 things that have kept people from putting as much money in private equity as they'd like to. And those are liquidity and access, or I should say lack of liquidity and lack of access. So let's start with access for a moment. There are an enormous number of dollars, many trillions of dollars, that cannot access private equity. Some of that, of course, is in the hands of retail investors. If you have $40,000 in a 401k account, you're not going to be able to put money into private equity. But it's much more broad than that. If you retire with $8 million of savings, you're quite a wealthy person. You've done great. But if you want to put that 20% in PE that a typical pension fund might have, that's $1.6 million. You aren't even going to, you might be able to make the minimum at 1 private equity fund. You're certainly not going to create anything, and you certainly shouldn't have 20% of your money in a single private equity fund. After all, a single private equity fund might only have 5, 8, 10 positions, and they're highly levered illiquid positions. So you cannot create a high quality, reasonably priced, diversified portfolio of great private equity with 20% of an $8 million portfolio. Now, if you're at the family office level, if you've got $100 million or money of that level, then you're basically an institutional level, and then you can access private equity. By the way, I should add, even on the institutional side, there are smaller institutions. I'm on the investment committee of my kids' private school. They can invest in private equity, and we'd love to as the board, but we can't. There's plenty of folks that have conflicts or regulatory things or other things that make it impossible for them to invest in PE. But now turn to the people who do have access. Many of you do have access to private equity, do invest in private equity, and that's fantastic. But for those folks, liquidity creates a significant challenge. Private equity is illiquid in 3 ways. First, of course, the obvious, you can't take your money out when you need it. Well, that's fine. Most of us have made our peace with that aspect of PE investing. You know you're locked up for a while. But second, they're going to ask you for money at unexpected times. So that's a different form of illiquidity, that suddenly you get a call and says, hey, you've got 10 days to send us $600,000. Even for people who are quite wealthy, that can sometimes be an unpleasant surprise. And then third, they give you money back when you don't necessarily want it back, when you may be very content to be invested in private equity, but they send you money back. You may not have other great investment opportunities at that moment, but they're just going to send you the money anyway. And again, nothing wrong with any of this. It's baked into the business model, but it means that managing a private equity portfolio is hard. And it's hard for the biggest pension funds in the world, and we've talked to all of them. It's hard for mid-sized foundations and endowments, smaller pension funds, and it's hard for family offices and other people with private wealth. Anybody with money who's tried to manage a private equity portfolio knows how tough it is. Start with the problem of just building the portfolio from scratch. So let's say you sell a business and you find yourself in the great position of having hundreds of millions of dollars. You set up a family office, you want to put 20% in PE. Let's say that's $90 million. Great. You identify 20 fantastic private equity funds, you allocate to them, you've done a great job. And in 7 years, you will have 20% of your money in PE, but you won't have 20% of your money in PE. Now you have 0% because they haven't called the capital yet, right? That money has not been put to work yet. So what's the solution? We argue liquid PE, which is what we create at PEO Partners. In other words, a product that performs like PE, but does so in a way that offers very frequent liquidity, right? So say, liquidity with 7 days notice, you can get your money out once a month. We have some products that have daily liquidity. So you can create with that ability to get PE-like returns, but with liquidity, look what you can do. When you start that family office portfolio, go ahead and allocate to 20 great private equity funds, but then also put money in liquid private equity. And then every time one of your private equity funds does a capital call, take the money out of liquid private equity, out of our product, if you go with us for liquid private equity, and put it into the traditional PE. And so on day one, you will have 20% of your money in private equity, or 15 or 12 or whatever the fraction you think is best. But let's just go with 20 as an example. You'll immediately have 20% in private equity, but it will all be in liquid private equity. And then every quarter that goes by, more of that money will shift out of liquid PE and into traditional PE. Now you might say, well, okay, but fine, what happens once you're all settled in and you've got all the money moved over? Well, the answer is it never quite gets to zero. I mean, it could, but it might not, because by the time all that capital is drawn, you're going to have received capital back, hopefully multiplied many times over by the great private equity firms you've invested in. And this is the biggest challenge that pension fund managers, endowment managers, and family office managers face. The need for what they sometimes call a funding asset solution or a liquidity buffer. So you put some money into a KKR fund, they put it to work in a company, the company delivered 10x, they send you back a check for $38 million. Great news. What do you do with the money? You know it's going to be called into other private equity deals over the next year or two, but you don't know when. And so consequently, you need to have a place to put that money that will deliver PE-like returns. If you put that money into cash, then you're getting no return on it, which is going to cause the allocator to be too eager to put money to work in private equity funds, even if they're not the very best, even if they're just okay. They'll perform so much better than cash. You're going to feel forced to put money to work too quickly. And we heard this over and over from top fund managers, that they are not performing as well as they could because they have to keep the hamster wheel turning by putting money to work. And so they say yes to average PE funds when they should be waiting for the very best and then putting the big money into the great PE funds. So you say, well, what if I use the stock market instead of cash? Well, first of all, it still returns less than PE. Plus with stocks, you have crash risk. And then you have a situation where if the market crashes at the very juiciest time when you would most like to put money to work in PE, you don't have capital to put to work because your liquidity buffer just got smashed by a market crash. So that's a terrible situation to be in. So some people have tried to compromise with a 60-40 portfolio, but the problem is 60-40 is really troubled. And in fact, I'm working on a new research paper on this subject with my colleague, Luis Becerra, probably the world's expert on 60-40 and stock bond correlation and related matters. You look back over the last 50 years and you say, my gosh, 60-40 is amazing. It's returned almost as much as stocks, but with much, much less volatility. In fact, over the last 50 years, there's only been 1 year, 2008, when you even had a double-digit loss on the 60-40 as a whole for the year. And even that year wasn't that bad. So 60-40 has delivered great performance without much risk. What's not to like? Well, the problem is looking ahead does not seem at all like looking backward. First of all, on a forward-looking basis, are you going to get the 9% that 60-40 delivered over the last half century? I think that's exceptionally unlikely. Now, again, I don't know what's going to happen next month or next year. I'm not making those kind of forecasts. But I can tell you with confidence that over the next generation, over the next 30 years, there is no way the 60-40 mix can deliver 9% annual returns or anything remotely like it. Look, you know what you're going to get on 30-year bonds. They pay 2%. So you're going to get 2%. Right? I mean, you could get less if they default, but let's assume they don't default, you're going to make 2%. And what about stocks? Well, they're priced to return probably about 5%. I would say the optimists are at 5%, the pessimists are even lower. So you take a weighted average of that, you're in the 3s, right? If you're an RIA, you're looking at your clients getting even less because they're going to take the RIA fee off of that. They're going to be very unhappy clients when they're getting 2.5%, 3% a year instead of the 9% a year they've seen in the past. But that's not the worst part of 60-40. The worst part of 60-40 is the crash risk. See, historically, the reason 60-40s never crashed is because when your stocks crashed, your bonds protected you. But the problem is that doesn't work in reverse. Right now, people aren't really afraid of a traditional stock crash where economic growth is imperiled. Everybody knows we're coming out of a pandemic. We're going to have growth. What people are afraid of is that inflation, which of course we just got a 7 handle today on inflation, that inflation is going to lead to Fed action to push long rates back up to where they were before COVID, i.e. to about the 3% level instead of 2%. Nothing crazy, We're not talking about, 1970 style massive interest rates, 1980 style. We're just talking about going back to the 3% that seemed perfectly normal in 2019. But if that happens, it's just bond math to say that the 30-year zero coupon bond is going to lose 30% of its value. And the stock market is going to get hit just as hard because stocks are long-term assets just like bonds, and they'll get blistered if interest rates move up that much. So we're looking at the possible risk of a 30% loss across the stock bond mix, which has never been seen before. So that doesn't seem attractive as a funding asset. And frankly, it doesn't seem to us very attractive as a place for people to have half or 2/3 of their money. What we suggest is that people need an asset that delivers stock-like returns, or at least 60-40-like returns, but that doesn't have that kind of crash risk embedded in it that unfortunately not only stocks, but even the 60-40 mix and bonds have right now. Okay, so
hey,
how
Randy,
do we do it?
Randy,
Yes.
Randy, can I ask a quick question?
Yes.
Great. So you're talking, and I love that you're finally including today's economic perspective. Obviously, we're going into a series of rate hikes. But just a quick question about what the impact on private markets. I mean, from my point of view, I live in this world of like crypto and hodlers, and
Right.
people borrow to buy crypto and people borrow to buy stocks. And, from a tax point of view, wealthy people borrow rather than, sell their equity stakes. But I mean, if rates are going to go up, I think it's going to have a tremendous ripple effect. So can you talk about the impact on private markets as well? Because I mean, it's private equity, right? So just go from there.
Absolutely. And in fact, if you don't mind, I'm going to fold it in so that I will get to your answer in about 2 minutes, because it's such a good question. It fits right into what I'm going to say, but not just this second. So give me 1 sec to get there, because it's so important to think about this. So look, hopefully what I persuaded you of is, well, if PEO partners, if Randy and Jean-Louis do in fact have a way to deliver private equity style performance, that is to say above market returns with muted drawdown, so if that crash comes, you won't get hit too hard, and modest correlation with stocks bonds, if they can do it, it would be incredibly useful, both for people who can't access PE, who will now have the ability to access something that performs like PE, and for people who can access PE as a tool in their toolbox, not to replace their PE, but as something helpful to use around the edges. So hopefully I persuaded you of that. Now I have to convince you that we can actually do it. So the question is, how the heck do you get private equity style returns in liquid markets? Okay, and here's the idea. We have the data on what private equity holds. There are about 1,000 LBO funds in America that matter, and we know what is in those funds. 8,000 private positions, we've got the data on them. So we're going to use that data to create a portfolio of hundreds of public companies that match the characteristics of those private companies, okay? And then we're going to buy those public companies. So buy what they buy, step one. Lever like they lever. When we say private equity, we are focused on the leverage buyout business, the classic buyout business developed by Warburg Pincus and KKR and Clayton Dubilier and Rice and so forth. Someday we may have liquid venture capital, liquid real estate, and other things. Right now, you have to start somewhere. We're starting with the core, the heart of private equity, which is LBO. Okay, and that L stands for leverage. The good news is they're not that levered. Levering 1.3 to 1.5x is all it takes to match the leverage that's in those LBO portfolios. And so that's what we do. Okay, and then finally, protect the downside. Okay, and that's where we get to Marty's crucial question, right? What can we expect from private markets if we get those rising rates? Well, those private companies obviously are expected to deliver cash flows for a long time, right? And those cash flows, if they get discounted at higher rates because interest rates are up, they have less value. Look at what happened in 2020, right? The market crashed and then it came back super strong. And why did it come back so strong? Because of the Federal Reserve. The Federal Reserve said, this will not stand. We are cutting rates. If you think back to your discounted cash flow, I used to teach intro finance and I love it. If you think back to your discounted cash flow formula, where you take all those future cash flows and discount them back to today at 1 plus the discount rate to the 20th power, the 25th power, the 30th power, depending on how far away it is. Boy, if you subtract 1% from those interest rates, those cash flows are far, far more valuable. And that's why we saw the value of both public and private markets rocket in response to that Fed action. Now, if it goes the other way, it's going to hit both public and private markets. Now, what makes private markets so attractive and LBO so attractive is they have a tendency not to mark the positions down very much. Again, go back to the first quarter of 2020 when COVID hit, right? Stock market was down 20%, okay? And if anything, the kinds of companies private equity holds were down more, because what they hold are what we call LBO-able companies. Those are the kinds of companies that can afford to pay the interest on a leveraged buyout. Remember, on a leveraged buyout, you borrow 3/4 of the money and you borrow at a blended rate of 8%. 3/4 of 8 is 6% a year. That means you have to be able to pay out 6% of the enterprise value of the whole company in cash every year. We're talking about highly cash flow positive, highly profitable companies. Now, those are the companies that benefited the least from the Federal Reserve's action, right? The ones who benefited the most were Tesla, where all the profits are 50, 100 years from now, because that's where that discount rate effect matters so much. So if anything, PE positions were probably down more than 20%. They were probably down about 28%. And then, as I mentioned, they're levered. They're not hugely levered, but they're levered about 1.4x compared to similar public companies. So now you're like, gosh, the PE should have been down 40%. Okay, but they weren't. They were down 10%. And why were they down 10? It's because their view, and I think it's not a crazy view, it's controversial, right? But it's not crazy, is just because the market overreacted to COVID doesn't mean that we are obligated to overreact. Now, believe me, I have friends who are in public markets who disagree and say they have to play by the same rules as us, but that is not the way the rules are written and not the way PE interprets it. So their view is, look, everybody lost their minds. They went a little over the top. It was understandable. It was a terrifying situation, but we stayed calm and cool, and we recognized that losses would be meaningful, but not devastating. Okay, if there is another crash, I think you can expect that private equity will smooth out the performance. Now, will the true value of their underlying holdings be only down a little bit? I honestly don't know. I think there's a good argument that if you have a big crash, that it's going to affect the holdings of private equity along with those public holdings. But I think that the returns you'll see on your statements will not be down too much. And we need to match that. If we're going to call ourselves liquid private equity, we have to make sure that we're not down too much. But we cannot use mark-to-model accounting. If our stocks are down 30%, we have to mark them down 30%. So how are we going to protect you and make sure that you only lose 5 or 10% in that scenario, not 30? The answer is we buy insurance. We're going to use the derivatives markets. We're going to buy put options. We have a very sophisticated derivative strategy. I can call it sophisticated because I didn't design it. It was designed by our colleagues at Gladius Capital, some of the smartest derivatives people in the world. They used to run the volatility desk at Citadel, and they're amazing and they run giant institutional portfolios. And so they've designed a hedge that is highly protective against crash scenarios. So look at what private equity does. And this will be sort of my last big push, and then I'll be done. I don't want to go over time. So private equity is amazing because they add value 6 ways for investors, right? That is vastly more than most money managers do. Marty has some great managers here today, and some of them may also be able to match that 6 even if they're not PE, but it's pretty unusual to add value 6 different ways. I'm going to tell you that we can match 4 of the 6. I wish I could tell you we can match all 6. We can't, but I'll show you why it's okay anyway. Okay, we've already matched the leverage. That's easy. They're not that levered. It's easy for us to lever in the public markets, no problem, right? We can match the hedging, and we can fully protect you just as well or better than private equity, but we are going to have to spend a little money to do it, right? You do have a 1 to 2% annual loss on those options in expectation because insurance costs money, right? Whereas mark-to-model accounting is free. Okay, so we match 2. Now, third, private equity, I told you we have the data on what they hold. Private equity is fantastically good at picking industries. If you look at the industry tilts, and they make huge industry tilts. I mean, healthcare and banking are similar size sectors. Healthcare is a little bigger, okay? In private equity portfolios, in LBO, there's 14 times as much healthcare as there is banking. And so there's 14 times as much healthcare in our portfolio as there is banking because we are going to match their industry base. And they move them around all the time. Every quarter, we update the portfolio to get the latest information because you look back a few years, software was a big underweight for PE. Now it's their biggest overweight. They're and here's the thing, it is their biggest source of alpha. They are fantastically good at picking industries. And so we want to copy what they do. I'm not smart enough to figure out what industries will do well, but I'm smart enough to copy off of the test of the guy sitting next to me, which is the private equity industry. And so by having access to that data, we capture their biggest source of alpha. We also capture their second biggest source of alpha, and that is being in those LBO-able companies. I wrote a paper, I can't even believe this is true, 27 years ago. I can't believe I'm that old. 27 years ago in grad school, I wrote a paper with my colleague, Christopher Polk, and what we showed was when you do these kinds of strategies where you buy what private equity buys, which is those high cash flow companies, think of it this way, high profitability, low multiple. That's what they buy. In order to be able to participate in an LBO, you have to be high profitability, low multiple. And those strategies work best within industries. You don't want to just buy all the lowest multiple companies. Then you're going to have a portfolio full of steel companies and you're going to miss the technology runoff. You want to have the high profit, low multiple tech companies and also high profit, low multiple energy companies and also high profit, low multiple consumer companies and everything else. And that's what we do. And that's what private equity does too. So we're going to match their industries And then within each industry, we're going to match the kind of companies they buy. We're going to match those LBO-able companies. Okay. And so we've matched the two biggest sources of alpha. What can't we match? We can't match the fact that they can trade on inside information, that they're allowed to know all the company's secrets as a private equity investor before they go and bid on a company. They can get in and spend 6 months with the CEO. No one's going to tell us the secrets of public companies. And if they ever did, we wouldn't be allowed to trade on that information. So we're not going to know that. And look, I've been sending my best students off to these LBO firms for 25 years. It's arguably the best job on Wall Street. They make crazy money. They're super smart. They're super hardworking. And when they get into these companies, they make massive improvements to them. They really make the companies better. They implement best practices. They take local companies, national or global. They do roll-ups of industries and reduce competition and increase profit margins. So they're awesome at that. And we're just buying little slivers of each of hundreds of different companies. So we can't make those changes. So that's going to put us behind them. Now, what's on the other side of the balance scale that enables us to match the average performance of PE, which we do, right? Number one, they have to, the industry is super competitive. There are so many smart people doing private equity now that when a deal is, there's a potential deal, they hire an investment banker, the owners of the company, the target company, hire a banker, and they run a process. They get an auction going, you get a bidding war, winner's curse, and the typical control premium paid is over 30%. And once
Randy,
you account for that,
Randy, we have 2 minutes.
2 minutes is perfect. That is exactly what I need. Thank you. So 30% control premium eats into the edge that they get from their operational improvements, but it still leaves significant edge left. In other words, we don't have to pay a control premium to buy stuff. They do. It still leaves them ahead of us. On a gross basis, traditional PE is going to outperform liquid PE by 1 to 2% because they have inside information, another 1 to 2% net of everything because they can make operational improvements, and another chunk of 1 to 2% because they don't have to pay for insurance and we do in order to protect you. That puts us 3 to 6% behind them on a gross basis. But those are the keywords that I mentioned. My former students make a lot of money doing this. The typical fees, when you add up operator fees, monitoring fees, origination fees, management fees, carried interest, and whatever other fees they've thought of that I don't even know about yet, are 700 basis points a year. We charge about 100. So the gap of 600 basis points puts us from 3 to 6% behind on a gross basis to 0 to 3% ahead on a net basis. If you look at our history, our back test of this strategy over time, it's closer to 3 than 0, but we know you're never as good as your back test, so we're humble. We say we can match average PE. We can't match the top quartile. Don't fire your PE managers to put it in liquid PE. That would be a mistake. But around the edges of your PE portfolio, we're here to help as a tool in the toolbox. Or if you cannot access PE, you can invest in liquid PE and it's a great alternative. Or if you have a bunch of money in bonds as part of a 60-40 portfolio, they are not reducing your risk the way they have historically. We can jump in and make a difference. And that's all I have to say. Thank you so much for listening.